Good morning, everyone. My name is Michelle Jacko, and I am the managing partner of Jacko Law Group, as well as the CEO of Core Compliance and Legal Services. And today I am joined by my wonderful colleague, Janice Powell, who is a senior compliance consultant at Core Compliance, as well as a former deputy director of RA supervision from Securities America. So she is going to bring some very practical tips with regards to the in-house perspective as we talk about today's topic, which we're very excited about, the SEC hot topic of compliance tips for evaluating your firm's advisory fees and expenses. And I'm not sure how many of you were able to join yesterday's session on SEC examination preparations and best practices. But Christian Schneider had shared with us that fees and expenses from investment advisors and how they are being assessed has continued to be at the top of the SEC's examination agenda. And in fact, it all started back when the SEC Risk Alert was first issued on April 12, 2018. So what we're going to do today is focus on truly what are those hot topics? What are the areas that you need to be concerned about as an investment advisor as it relates to advisory fees and expenses? We're going to be reviewing everything from disclosures to actual SEC examination questions that are being asked and what some of the observations were in the 2018 Risk Alert, which still apply today. We're then going to walk you through tips and recommendations on how to prepare for your SEC examination in this specific area, and then go through what some recent document requests are that we've seen from the various SEC regional offices. I think that one of the most, what I would say, practical takeaways that you will receive during the session is we're actually going to walk through a case study and try to highlight, perhaps in a little bit of an exaggerated way, what some of the most common advisory fee and expense issues you may face as a chief compliance officer. And then finally, provide you with some key takeaways. So without further ado, in the next 15 minutes, we're going to be diving into the essence of the Risk Alert. And, from my perspective, it's very interesting as we were just issued this week with the 2021 examination priorities from the staff. The exams division once again focused on advisory fees and expenses in various components of the 42-page release. So, this is an area that is, constantly being reviewed. And I think that the biggest concern that the SEC is seeing right now is about the disclosures that we're making to clients. And I'll give you a couple of examples. I've had certain client firms ask, may I pass down, there's fees that are being assessed that are rather high for performance measurement systems, such as Orion. And the question is, can I pass that down to my clients? While you may be able to pass that down to the clients, the question is, have you informed them, disclosed, received their acceptance for charging those fees to them? So the first thing that the staff's really going to be taking a look at is, what is in your advisory contracts? When that client signed and engaged the firm for investment advisory services, did you actually disclose to them any and all fees that were going to be assessed to their account? Now, obviously, some fees, such as those that are passed on through third parties, such as third-party asset managers or the custodian, you're not expected to disclose their exact fees. That would be disclosed in their documents. But those that the advisory firm will be passing down to their clients, you really have to take a step back and say, did I give the client an opportunity to make informed consent to these fees that we're assessing? There's also an area of concern with regards to whether or not the advisor is actually following what's in the advisory contract. So, typically, advisors will charge either a percentage of assets under management. They could do flat or hourly fees, and that'll be disclosed to the client in their advisory agreement. In the event that they are doing a percentage of assets under management, many times what we see are tiered fee schedules. And the question becomes, if the client has multiple client accounts with family members, what we'll refer to as a household, is the advisor aggregating all of those various assets in order to see whether or not a fee breakpoint can be achieved so that it will be less expensive as their assets increase, then the advisor could pay less of an advisory fee? And if so, how is that operationally occurring at the firm level? Finally, this last bullet point, examinations find that advisors are not adhering to the terms of the agreement or disclosures that are appropriate. Here's what I want you to think about. A lot of the times in the advisory agreements, we'll see language that, in the event that the client may terminate the account, and especially in the case of assessing fees in advance, those fees will be rebated to the clients on a pro rata basis from the time of the point in termination. And the question is, have you actually done that? Okay, so with that in mind, Janice, I'm hoping that perhaps you can walk us through what some of the examination observations that were made by the staff.
Sure. Thank you, Michelle. The fee disclosure issues continue. We saw that in the most recent exam priorities. It's been in there for a couple of years. It's also reared its head in a couple of other risk alerts, such as the risk alert about supervision of remote offices. So we know that the SEC continues to look at trying to make sure that assets are protected and that clients are able to make that informed consent. So specific to the risk alert on advisory fees, the first is incorrect account valuations. That's one of the big issues that they found, was that the staff observed advisors overbilled clients due to the incorrect fee evaluations of underlying assets, such as basing them on the cost instead of the current market value. Advisors also valued client accounts using different metrics or other processes other than what is disclosed in their client agreements or in their ADV. The next area in which deficiencies were commonly found were related to timing and frequency for which fees were billed. Billing errors such as a monthly instead of a quarterly or at some other interim period other than what was identified in the agreement. In addition, the staff noted advisors failed to prorate the fees. Just as you said, they failed to prorate fees for when they joined in the middle of a billing cycle or they terminated their relationship in the middle of a billing cycle. They failed to rebate the fees at that point. The next issue that they found was actually applying an incorrect fee rate. Advisors that applied an incorrect fee rate, either higher than what was agreed upon or, in some cases, double billing the client, received deficiency letters as a result of these examinations. Firms have been fined for these types of practices. The staff also noted that advisors were charging performance-based fees to non-qualified clients, in direct violation of Section 205 of the Advisors Act. So, there's some problems there when, considering what is actually being billed in fee practices. Another issue that resulted or added to this deficiency letter was, omitting rebates and applying the discounts incorrectly. So this kind of goes to the householding issue, or if you indicate in your disclosure documents that you'll rebate certain fees, such as 12B1 fees or other fees that may be charged to the firm, towards the account. If this is agreed upon in the client agreement and you don't rebate the fees or rebate them as you stated, that presents a problem. Again, highlighting that, some households were not even defined the same way across the firm. You have different offices, and this is especially a problem when you have remote offices. Remote offices and leaving it up to each individual advisor or group of advisors, especially in contract situations, might run into this problem where they apply householding in different manners. So there should be some consistency across the firm as to what is the definition of a household. And finally, of course, what we shouldn't be surprised to see is disclosures involving your advisory fees. So combing through the ADV, that the staff noted deficiencies in the disclosure documents. Specifically, the staff highlighted that certain advisors' form ADVs were inconsistent with what their actual billing and fee practices were. and in some cases lack disclosures completely regarding fees or markups on disclosing any revenue sharing arrangements. And finally, advisor expense misallocations. This one, though the risk alert is really geared towards the traditional advisor. This was what was kind of what came out of advisors to funds, either private funds or registered funds, where they misallocated expenses to the clients instead of to the advisor, contrary to their operating agreements, their client agreements, and their disclosure documents. Specific deficiencies that the staff noted were fees and expenses related to distribution, marketing, and regulatory filings and travel, that they were passed on to their clients as opposed to the fund. So in these areas, it's no surprise that these advisors receive deficiency notices. So there's some things to think about and to consider when especially doing an annual review or evaluating what your fees are, and if if the firm's making a business decision to change them, and recognizing kind of the downstream effect of the things that need to happen or occur when that happens.
Thank you, Janice. And I just want to add, I know that the private fund risk alert highlighted a lot of the allocation issues. It continues to be, for the private fund advisors. So that continues to be a big area of focus. We are having numerous questions come in. I'm going to take the first two that came in and we'll try to address them all throughout the session. The first question is, in a discretionary service, how do you address the potential for all-in fee variation due to portfolio construction decisions? So for example, if we decide to hold a security with higher fees for some clients due to their embedded capital gains. And I appreciate that. I really think that it goes to Janice's point, and I'd love to hear your thoughts, Janice, as it relates to disclosure and how you're going to be calculating fees. So what I'm starting to see on ADVs, which I think is incredibly helpful, is to the extent, and I know your business folks might not want to do this, but to the extent you could actually put in a sample of the calculation of the differential for those clients that if we're going to either bill at a different rate and a different methodology, what have you, provide whatever that formula is in a generic sense as an example within the form ADV. That way there's transparency. And hopefully that if there are questions, that's something that the investment advisor representative then can address with the client during client meetings.
I agree. I think that's very helpful, and I think the SEC has said that before. Is that any time that you can give an example of a fee calculation or other numbers that can highlight what your actual practice is or what the impact is, I think is very beneficial.
Right. The other question that came in that I do hear a lot is it an issue if we household to achieve a reduced fee rate, but take the fees out of only one account? And that's not a problem so long as the client is aware, or perhaps the client actually gave you direction to do so. So I think, particularly, when you're looking at, and I understand for tax and other reasons, that would be the logical decision to make. But before we just automatically do that, make sure that when you are going to take those advisory fees out of just one account, that we're transparent with the client and we're letting them know and have their authorization to do so. And that will avoid problems, including any kind of complaints, litigation in the future. And finally, Janice, I'm going to give you this question. Let me just see here. Should the firm's fee practice be included in the Form ADV 2A as well as the IA agreement? If only one, which? Do you have an opinion on that?
Well, I think that it should be disclosed in both places. Both places serve as disclosure documents. And in something like this, where it is a very highly looked upon practice, that you would want to disclose it in as many places as you could. The problem with that, or what you want to make sure that you're concerned with, is making sure that they are, that they align, they are synced together. You don't want to have one billing practice, updated in your client agreement and then one in your ADV. And one of the issues that you could see in something like that is that you're required to do an annual updating amendment to your ADV, and oftentimes that's the document that gets changed if your fee billing practices change. However, oftentimes the investment management agreement is neglected, and so you don't change that as well because there's no obligation that you have to review that every year. So that is probably one cautionary tale that I would, be concerned with, is making sure that if you do disclose in both places, that when you amend one, you amend the other.
Fantastic. And that is a great segue to this slide, which I'll bring up that question again in this context. In preparing for an examination, I can tell you since the middle of 2018, almost every single one of our clients have received, as in one form or another, as part of their SEC examination experience, questions related to advisory fees and expenses. And here's where I want to share with you, if you haven't had a recent examination, this has been our experience. The staff will ask, obviously, for a list of all of your client accounts, those that have terminated and what have you. And what they will end up doing is selecting certain accounts and asking you to provide for them any and all copies of their investment advisory agreement, including any amendments that might have occurred at least within the last 2 years. And then they're going to be asking for your fee billing related to those accounts. And what they're checking is to see whether or not the advisory fee, which is memorialized in the contract, is the same as that which is being assessed to the client. And here's, in some instances, what has happened, especially for those of you that have what I'm going to call an advisory firm that has been around for 20 or more years. The way that, sometimes the business gets conducted is we don't want to disturb the client. We don't want to have to bother them to, provide a new advisory service agreement. So during your meetings with your clients, the investment advisor representative may say, I understand you're bringing in more assets. We'll lower your fee, not a problem. And it's just part of the sales process. What hasn't necessarily occurred, especially in the cases where perhaps the client has additional service needs and that fee, instead of going down, goes up. It's never a problem to go down. The problem is going up when you're increasing that fee for whatever reason or charging a different fee other than that which is memorialized in the contract. In the case where the fee goes up due to a variety of different circumstances, the staff will ask, where did you document that it stated and that the client was aware that the fee was either different or increased from that which is memorialized in the advisory contract? And for the older firms, that's been a problem because so much of this is relation-based, and we get it. That's called the practicality of the business. But the contract is a legally binding document, and that's what sets the expectations for that particular client relationship. And that's what the concern of the staff is. So as they go through this journey, if they happen to see certain areas of interest, shall we say, they will go into a whole bunch of questions. And these are the recent questions that they've been asking. And I want you to think about, how would we respond to this? And these questions are being asked regardless of what the firm size is. Who in your firm is calculating the advisory fees? Who's sending the invoice or submitting the advisory fees to the custodian? Who's testing your advisory fee calculations? And I want you to think about, do we have some kind of backup documentation, or how would we evidence that we're testing advisory fees for accuracy? Which software programs or systems are used in calculating fees? And if the system is not being used, and there are reasons, and there are firms that I've seen that still do not have systems out there, that is where we're starting to see human errors, and the staff will latch on to that. They want to understand how you're reconciling advisory fees, and then and this is really critical, have any of your processes changed within the last 5 years? Okay. And what they're going to be turning to is your policies and procedures. And I know for many of you, the operations team, whoever is doing the advisory fee billing, they may have their own, what I'm going to call standard operating procedures. The question I have for you, is it documented and is it in writing? Okay. So going back to this question about, in terms of, should the advisor's fee practices be included in the ADV 2A as well as the IA agreement? as a lawyer, I can tell you, you must include it in the contract, because that's your agreement with the client. And that's the document that the SEC is really going to hone in on to show that this was the expectation of the client. To Janice's point, which I thought was incredibly practical, as you're going through, especially for those of you with fiscal year ends of 12/31, so you're going through your ADVs this year, here's what our recommendation would be from a risk management perspective. Take a look to see how you are defining household. Is it clear? Is it transparent? Are we aggregating client accounts? And in some cases, I have clients that do not aggregate, and they put that in black and white in the ADV. We do not aggregate any of our client accounts for purposes of fee billing. If that's your policy, that's fine, but you have to be transparent about that, okay? The other question, Janice, I just want to raise to you before we move on to the next slide is, how specific must the definition of household be spelled out in Form ADV Part 2A? Do you have any thoughts on that?
Well, I think it needs to be specific enough that the client can understand, because it's a disclosure document. It helps the client understand and make an informed decision about whether or not they want to do business with you. So if you spell it out in how you household, then the more you can spell it out, the more the client can make an informed decision. And then as long as you have then articulated that to the client, you have memorialized that in your agreement, and then your policies and procedures and internal controls follow that disclosure, then I think you're going to be okay. But I think it's important to make sure that the client understands how and when they can receive, potential break points and, pay less in advisory fees if they bring in more assets.
This is an interesting question I'll also raise. The question is, do you see an issue with stating a standard fee schedule in the ADV and Form CRS that only about 30% of clients are actually on due to negotiated fee reductions for the remaining 70% of the clients? And I'm going to address that because I've had that issue come up specifically in various examinations. First of all, we still have what I'm going to say, an investment advisor is in the area of conducting business. You are allowed to negotiate fees with the following caveat. The SEC looks at advisory fees at an enterprise level, meaning how are we treating similarly situated clients in similar portfolios? And so their concern is that if I have, one person, let's just say Sally on one side and Joe on another, they want to know that if Sally's in a large cap portfolio being charged 100 basis points, why is Joe being charged 150? And there could be a variety of reasons. Perhaps Joe requires additional reporting, additional meetings. Perhaps you're doing family office services for Joe. There could be a lot of reasons why he is assessed a higher fee. The concern, and we talked about this during the examination session yesterday, is that especially where you may have multiple branch office locations, you are seeing that Sally is in the California office, Joe is in the Florida office with the investment advisor representative, or he's based out of that, for servicing purposes, and they have different fee schedules for the exact same portfolio. And that is a problem. That is an issue because you have similarly situated clients being treated differently. While you could negotiate your fees lower, your fee schedule, there's an expectation by the staff that the fee schedule is the fee schedule, meaning that this is truly your standard fee schedule. So exceptions should be just that. They should be exceptions. So if you find, and I've had this happen, where the staff came in and they said, you state in your ADV, for example, that your typical advisory fee is 100 basis points for this strategy. But in actuality, when I look at all of your clients in this strategy, it's 70 bips. Your fee schedule, you need to evaluate to see what is the true expense. You can't negotiate every single client account down to 70 bips. If that's the case, that should be your fee schedule. So I'm just sharing with you that's their experience that I've seen out there, and in my conversations with the staff. You still can do, again, it's very important to have those clear, transparent disclosures that you have the ability to negotiate fees. And please don't take this as you can't negotiate fees. There are reasons why you would have a lower fee. but make sure that as you're reviewing your Form ADV, that disclosure is as transparent as possible. Okay, I think with that, Janice, we have so many questions coming in. I'm going to try to get to as many as we can, but I know in the interest of time, we've got about 25 minutes left. Could you just walk us through some of the recent SEC fee and expense document requests that we're happy to see?
Sure. The SEC is, as you started to talk about earlier, in requesting specific documents about, who's doing what, who's calculating, who's testing, who's doing that. They're asking now that you provide all current contracts and agreements. They want to see, what is your standard, what is your, your side letters, what types of agreements do you have in place that affect fee billing. The next thing that they want, they'll ask for is an Excel spreadsheet that details the billing rate, market value used to calculate, the advisory fee, the total fee billed, which accounts did you group together in household, and then provide any ongoing analysis to that. What did you do to determine that these are in fact fair and accurate according to your disclosures, your agreements, and your policies and procedures. And then provide a list of all revenue sharing expenses and arrangements. I mean, that's huge in not disclosing all the revenue sharing arrangements that you might have with your custodian or with other, business partners, and making sure that if there's a conflict in there, that conflict is disclosed. So they're asking for all of these things and really kind of getting into the weeds, so to speak, about what is actually occurring in the advisors, with their books and records, with their fees, and how they're managing this.
I'm going to go to another question that was asked, and it was, Janice, I'd love to hear your thoughts on this. If for business competition reasons, a firm concludes that it must meaningfully reduce its fees on a going forward basis, is that a material change that must be disclosed in Item 2 of Form ADV?
Well, I guess it depends on, again, this is a facts and circumstances type of a question, where it depends on when you meaningfully reduce your fees. Certainly, if there is, a business decision to reduce fees just to remain competitive, then it doesn't hurt to say this is a material change to our business practices and what we've done all along. You could highlight that in Item 2. I don't see any reason not to, but, it does also kind of bullet point to a regulator that, hey, we've made this change. So when you make this change, I would, make sure that these takeaways and things that we're talking about today are looked at to ensure that you don't have any legacy accounts that might not benefit from this reduction in fees and so forth.
Okay. And I'll just take one other question. What tips do you have for firms that rely on the custodian to automatically calculate, invoice, and deduct fees from client accounts? I'll take that just ever so briefly. I will tell you, this is where I'm seeing issues pop up, that the disclosure that's being provided on the ADV does not necessarily match that which is actually occurring in practice. So, sometimes I've seen in terms of disclosure that we are going to rely upon the, for purposes of percentage of AUM, the value as calculated by the client custodian as of the last day of the calendar quarter. Okay, and you put that in your disclosure, and that's very important. But here's what I want you to think about. We have other situations where it could be average daily weighted balance. There's all these different things, and you really have to take a look at, first of all, do we understand how that calculation is occurring? There's a lot of different ways that it could be structured, but where you're also using performance, reporting for that purposes, and when you're doing what I'm going to call the fee calculations, there are certain systems out there that I've gone through a long journey with the SEC staff and responding to them to really understand that the way that we thought that this particular provider was getting the daily downloads from the custodian, it didn't necessarily, match up with what the calculations were. Is it trade date or is it settlement date? What are they getting from the feed? So it's not going to be a settlement date if they're getting daily feeds from the custodian, because those transactions haven't necessarily had time to settle. So I think, in terms of, is there any problem with the custodian automatically calculating and invoicing and deducting fees? No, you're going to put in whatever that advisory fee should be, but you've got to take a look at your ADV disclosures and really make sure that you've articulated how and what is that advisory fee. Is it based on settlement date? Is it trade date? Is it, what are we going to be doing here? Is it average daily weighted balance? We've got to take a look at that and make sure that we're giving as much meaningful information as possible. But that in and of itself is not a problem. Hopefully that helps. What we wanted to do is, I think that this is going to be hopefully a meaningful exercise. I wish that we were in a live forum and we could have you participate, but we're going to do the best we can with this in this form of this case study. And the reason we're doing this is to really highlight for the next 5 minutes, what are some of the most prevalent issues that we're seeing as it relates to advisory fees? So here's your hypothetical. During an on-site exam, Chuck learns that Exposed has been in business since 2000. Since that time, the firm has used 3 different investment management agreements, all of which have differing disclosures and advisory fee structures. In the beginning, Bobby Axe wanted to charge all clients a flat fee. It was just going to be 100 bips. But over time, as the firm came to service high net worth families, Exposed moved to a tiered fee schedule. But in all of the investment management agreements, the firm never disclosed whether they householded assets for fee billing purposes. In practice, it was left to each advisor to determine which accounts would be aggregated together. Chuck is the SEC examiner. He asked for the oldest client account and to review all investment management agreements associated with the account. Chuck is provided with one investment management agreement, which provides a fixed 1% AUM billing fee. However, when reconciling the billing of the account with finance, Chuck discovers that the account is being billed 1.1%. So, when he asks finance, why is this client being invoiced for this amount, he receives the following reply. In 2008, we moved to a tiered fee billing schedule, and based on assets, this family should be charged 1.1%. Chuck asked Taylor, who is the CCO, to pull all the reconciliation documents on Exposed billing practices for this and 10 other accounts, to which Taylor replies, "It may take a few days as I have not gotten to this yet." And in Taylor's situation, and I apologize, let me give you some context. We've got Chuck, who's the SEC. We've got Taylor, who's the new CCO. And he realizes that, we've got records all over the place and we haven't been able to gather all of this information yet. So, Janice, in that context, in this hypothetical, I wanted to just kind of talk about, I'll go back to the previous slide. What issues do you see? And then as a firm for Exposed, what actions should they take?
Sure. Kind of one of the, I guess, the big things, and we've kind of touched a lot about it this morning, is that there are differing investment advisory agreements. They changed midway through their business model, but they didn't go back and look at others. They left it to advisors to aggregate a household, so each advisor could be doing it different. They were billing the client, differently rather than what was memorialized in their advisory agreement. Likely the client was not made aware that they had an increase in fees. And, I kind of feel bad for Taylor, this new CCO that's probably trying to dig his way out of things, but he seemed to be sort of aware of the problem. He just hadn't gotten to it yet. So, those are some of the issues that I could see. There's probably more, but, just right off the top, that's what I see. So some of the actions that I think that they should probably look at is, doing an audit of all accounts. Look at the investment advisory agreement, especially the legacy accounts pre-2008, to see if any of those accounts maybe need to have a new client agreement established. And I know that that is not always a comfortable conversation that advisors do not like to have with their clients, is, a discussion regarding fees, especially if they're going to increase. I think that, if they come into, during their review, a situation where there have been clients that are overpaying, that they immediately develop a plan to rebate any overpaid fees. That will be a big thing. The SEC is looking at this, is whether or not they're willing to, kind of make the client whole and rebate their fees. I think that they need to update policies and procedures as well as establish internal controls to kind of prevent something like this from happening in the future. Is how do we go from making a business decision to change this, and what are the steps necessary to ensure that proper fee billing and expenses are made. And then, I don't know, depending on the size of this, whether or not they may need to seek some legal counsel or, potentially self-report. That's, always an issue that, you never want to jump into, but certainly seeking, the input of your legal counsel would provide the necessary guidance as to whether or not this becomes a material issue. So those are just a few of the things that I think they should look at, and then actions they should take.
Yeah, and I'll tell you the biggest focus, and that's a great way to transition to the next slide. The SEC, when they do find an issue, I'm letting folks know they will typically not stop at the 2U mark. They will go back approximately 5 years. Why? Because that's your required books and records. And here's where I want to focus on current questions that we are seeing out there in the industry from the staff. The first one is the big one. How does the firm handle fee billing for deceased clients and terminated client accounts? And that might sound so simplistic. I have recently, been doing a lot of investment management agreement revisions. And as I'm going through that, sometimes I'm seeing language that'll say, we do not, especially in the case where you're assessing advisory fees on a quarterly basis based on a percentage of AUM, to the extent that they're billed in advance, I've seen language in contracts that say, we will not be refunding these fees. And I can tell you that the SEC will say, as a fiduciary, if you're not providing services, our expectation is you will be rebating those fees and getting those back to the clients that paid in advance. The bigger issue comes from deceased client accounts, because sometimes someone passes away, the advisor's not aware of it. We're managing the client account until the account is restricted and frozen for transactions. And I want you to think about this, other than fiduciary obligations based upon, again, your investment management agreement setting forth how you will continue servicing that client account. You have to, first of all, look at what was my last date of service for this account? When did we stop actively managing it? And at that point, I need to rebate those fees back to the account. And in some cases, the question is, we haven't necessarily traditionally done that. What do we do? And you have to take a look, who was the beneficiary on the account? The expectation from the staff is that you're going to go find those beneficiaries and make a good faith, reasonable effort to rebate those fees. So, I think as part of your annual reviews this year in particular, take a look. A lot of times I think we make assumptions, everything is, we've disclosed we're always going to rebate those accounts, but in practice, we are finding that there could be gaps in internal controls. And so I think it's really important to take a look at that. I also think, to Janice's last example that she's provided, where we're walking through, what we should be thinking about in terms of testing some of those client accounts, pull some of your, what I'm going to call the longest legacy clients of the firm. Take a look at their contracts. Take a look at, really, you could use this case study as almost an example of, here are all the things that I should be thinking about. And let's see, did the advisory fee change over time? Might it have increased? Okay. If it did increase, was it disclosed? How was it disclosed? How are we documenting that? Is it simply in our CRM system based upon an investment advisor rep's notes after their client visit that I decided I'd discount Joe's fee? Or did we actually go back and give some kind of written document to the client saying, either via, negative consent, amendment of the contract, what have you, that this is indeed how we will be billing for your account going forward. Briefly wanted to bring up the COVID-19. We talked a lot about this yesterday. And the question that's being asked is, has the firm's supervisory oversight of fees and expenses changed during COVID-19 or as a result of COVID-19, or did they change as a result of a merger or acquisition? And I'm seeing this more and more, especially during COVID. Business owners have seen an opportunity to go through M&A activities. And when you're onboarding a new firm, a lot of times those fee structures may not align with what your current fee structure is. So you have two choices. Either A, we're going to adopt that, what I would call the merged clients fee structure, at least for an interim period of time. We're going to disclose it in the ADV, and we're going to let folks know about the differences in the fee structure. Or B, we're going to have them all fold into the mix and go to one fee schedule. And then what does that mean for advisory contracts? And the other thing that I'm seeing is that to the extent that you are, as an investment advisory firm, passing down certain fees, such as for performance reporting, to your clients, make sure that those client contracts that you might have been assigned to the investment advisor, you can't just automatically start assessing those fees without disclosing it to the clients and making them aware, because that might not have been on their previous fee schedule. So really take a step back and think about that. Next question was, what controls are in place to monitor fee billing in remote branch offices? Okay, and that went to the November risk alert that came out on that topic area. And what I want you to think about is that in the SEC's concern in this regard was that it's more challenging to know what is being done at the remote location, particularly if that branch office is doing their own fee billing and not the home office. So if that is your scenario, take a look and see how are they calculating it. And again, looking at the definition of household at the enterprise level, are they consistent? And then finally, how do you document exceptions to your disclosed fee structures? Some of the questions that we received today were about the exceptions. And with regards to what if we do charge more, and I'll go to one of those questions right now, Janice. How should we document that? And exceptions should be just that. They should truly be exceptions. They should not be the norm. And here was the question. It's a long question, so we'll try to at least answer a component of it, which is, what are your thoughts about the practice of reviewing fees that had a significant change or increase from the prior fee taken? If the difference is due to cash inflow during the period, we will prorate the flow and reduce the fee. And I think that's what most advisors do. Cash outflows are not prorated. Again, I think that's pretty much the norm, but again, it should be disclosed in the ADV. So the question is, would it be best to create a dollar threshold or percentage to apply to all cash flows to be fair to all clients, or eliminate this practice completely and charge for the full period for the cash inflow, which might have happened towards the end of the period? Do you have a thought on that?
That's kind of an interesting dilemma, and I've seen it done both ways in a couple of different firms where I was the CCO. So, I think it's probably a good practice to, your policy should state what is your desire to do. And typically that desire is probably to try to capitalize on the advisory fee. And that is, to make sure that you're charging when you have these big influx of cash. But it's important to make sure that it's disclosed how you're going to do it. I think probably an easier, or maybe a best practice way to do that is to set that threshold. We're not going to worry about if there's less than a 5% or a 10% change, or a specific dollar amount, so that you're not having to go through and look at all these smaller thresholds that may not really make a difference. It's important to memorialize it. It's important to make sure that the client understands that if they have a significant cash inflow, that they will be charged fees on that for whatever prorated period. Or if they're going to charge them for the whole period, to make sure that that is fully disclosed as well. I think the more information you can give to the client about that, the better off you're going to be. And then make sure that you have internal controls to monitor that during your fee billing period. So if you're doing it quarterly, to make sure that you have the internal controls that will catch and make sure that each client has that same opportunity to, I don't know if it's an opportunity, but they're treated the same threshold, same amounts, and are valued correctly.
And I'm going to throw out two business practice questions that we received, because I think it's apropos as we go into the final two slides. The first one is, what tips do you have for firms? Excuse me, let me retract that. Is it acceptable to request a 30-day notice from clients for termination of the agreement and charge fees for those 30 days? And I absolutely believe a notice provision is just that. It is a notice provision of your intent to terminate. So if you are still actively managing that account, then it's perfectly acceptable for you to continue charging those fees. And let me just see here if I think there was one other question, Janice, I wanted to throw out to you. Let me just see here. I apologize. I'm going to have to go into that. Let's go into the next slide, and I'll take that away. I know that you had some final thoughts for the participants, and I think that there's 2 new questions that came in that we will address at the end.
Okay, sure. Takeaways from this risk alert and today's presentation, that you want to try to maybe look at, especially as you're doing your annual updating amendments and reviewing your policies and procedures, is inventory all your fee revenue sources wherever the firm is receiving fees, just to make sure that you are disclosing those fees properly. That is a significant deficiency that seems to rear its head even outside of this risk alert, is not disclosing any types of revenue sources that may be a conflict. Next, you want to make sure that you're reviewing disclosures about your advisory fees and expenses. How do you calculate them? What frequency are you aggregating, on a household? So, I would do some comparison between your policies and procedures, your ADV, and your client agreements to make sure that all of them align with your firm's business practice and what you're actually doing. Then I think it's important to, implement your supervisory controls. How are you doing this? How are you evidencing that you are on top of this process? What kind of either forensic or current testing are you doing to ensure that fees are being charged and billed properly to the clients? Who's doing it? Is it somebody that's in operations? Is it the portfolio manager? Is there somebody that's incentivized to maybe try to inflate numbers? So you want to make sure that you have adequate supervisory controls over that issue. And then I think, from a practical perspective, is that, if the more you can centralize the process, the better I think the process goes. You don't have to worry so much about, a few clients that might not, get billed. Everybody does it the same. If it's done, if you have a system that can help with that, I think you're far better off than trying to do it manually or allowing multiple people to do it. So, and then I think last but not least, it's a thorough review of your policies and procedures and implementing, those controls. If you don't, do it, the one thing I think I would probably suggest, and we've mentioned that before, is that if you are, if you've got legacy agreements, go back and review them and make sure that they are still on par with what you've disclosed to your clients.
I think those are all great points. The one thing that I just wanted to bring up, again, from a practical perspective, we've gotten 2 questions. I'll throw out one, Janice. When would you recommend to start fee billing on an account? At the time the advisory agreement is signed, when money comes in, or when the money is actually invested?
In my experience, I've always been a proponent of when the money is actually invested, and one that makes sure that the client is invested in a timely manner and in accordance with either an IPS or with their client objectives. You want to make sure that they're being provided services for that fee. If you do it upon the time that you receive the assets, you want to make sure that you've also disclosed that you're billing on cash, which is another deficiency. It's not mentioned in the risk alert, but cash is one thing that needs to be disclosed.
Yeah, and I'll just throw out one other point, because we've got just about a couple of seconds left. The one thing that I will share with you that I'm seeing again and again is that, to the extent that you are billing in a unique structure differently, what have you. Make sure that you're looking at the disclosures. I know that we said inventory or contracts to look for legacy customization. That is the most important tip that we can leave with you today. I think all but 2 questions got addressed. Janice and I would like to thank you so much for your time. If there's anything that we can do, our contact information is on this slide. We also have the Core Compliance booth. We're available to answer your questions. And we thank you so kindly for attending today. Thank you.
Thank you.